If you're ready to invest in property right now, there is one thing costing you millions, and it sounds a little bit like this. Interest rates rising means the market will crash. Borders closed during COVID means prices will tank. Builders going bust means the city's done. Yet, despite all the headlines, multiple markets boomed. In this video, I'm going to share exactly what the wealthy do to actually invest in any market cycle and how to get opportunities before they hit the headlines. I'm Arjun Paliwal, and we've generated over $500 million in equity for our clients, and personally, I've actually built a $20 million property portfolio. I'm going to be giving you 5 fundamentals we use to actually find golden opportunities first before prices rise, so you too can invest and build wealth. But first, we need to address the root cause that's costing investors millions. It's what I call if this, then that thinking. For example, interest rates rise equals markets crashing. And it sounds logical because people look at it and say, well, rates rising equals repayments increasing, and repayments increasing are equaling bad affordability. And with bad affordability, banks are also not going to give you as much money and lend less. Families worry, people overthink, and as a result, people will take less action. Now, it's this oversimplified thinking that seems logical on paper, but it's actually wrong in reality, that led many people to think house markets were not going to perform. Now, this might have been true for, say, places like Sydney that only grew 12.1% between 2022 and 2025. While Sydney and Melbourne slumped, many other markets sprinted. Perth surged 47.7%, Adelaide surged 43.2%, and many regional markets like Bunbury actually went up 61.5%. Rockhampton surged 53.6%. Townsville grew 51.3%. Sydney is not Australia. You know, 2 cities that are major markets, by the way, don't decide the fate of an entire nation. But look, let's get real for a second. It's not entirely your fault for thinking like this. The media will continue to feed you with data points that just don't tell you the entire story. For example, this is an article from 2022 as rates were rising. Australian home prices fall for 6 months in a row as interest rates bite. The article talks about Australia falling, which isn't a lie, it's true. When you see cities that large down 8.6 and 5.6% on the index, which is stated within the article, of course they're going to make a big difference on the national figure. I already touched on it before. You're not buying all of Australia when you buy property. You're buying one property in a city, in a suburb, in a council, in a street. But what the article doesn't really focus on, many markets are actually doing quite well. Adelaide was actually outperforming whilst the national market was declining, actually up 16.5% for the last 12 months of change in dwelling values. So even though these things are happening everywhere, rates rising, repayments increasing, affordability shifting, and banks giving you less money, there are some cities going in the opposite direction on that annual basis, even though the country actually stepped back over that 6-month period. Now, something else on this article that's going to scare many more people is the Reserve Bank's commentary. Reserve Bank modeling shows home prices could fall by 20% peak to trough in its worst case scenario. So why does the media do this? Well, it's because they want the extra clicks. You see, over 10.4 million Australians are just in these 2 circles over here. Look at the rest of the country. That's just massive when you think about it in terms of how many more properties, how many more people there are. But if you now take these 2 and you say add on Ballarat, Geelong, maybe Bendigo, or even add on Newcastle as an example, I haven't even stretched this much, and I've just added an extra 700,000 plus in population. That takes it from circa 40% of the country's people up to about 42-43%. If you expand this out to dwellings, there's approximately 11 million dwellings in Australia. There's more than 6.8 million dwellings outside of just Sydney and Melbourne. So look, if you're looking at this map and going, well, I can't afford here, or these markets aren't doing well, the country stats say it's bad, well, that's only 4 million dwellings. There's 6 million other dwellings all over the country that you could be looking at to grow some serious wealth. You need to stop looking at Australia as a whole when it comes to property investing. You need to look at maybe here in Geraldton, or maybe you go across the other side and you're looking at Townsville, Rockhampton, Toowoomba, Adelaide. There are so many other cities. In fact, there's over 6 million other dwellings all across these other cities, and you're fixated on an article that's focused on these 2 cities and their surrounds just here. So you've got to get smarter when it comes to investing by becoming borderless. Now you might be thinking, Arj, that all sounds good in theory, but what does it actually look like in practice? And here's someone who's actually taken action based on all of that data and not just the headlines. And look, I want to introduce them to you. Their name's Michael Thomas. Now, Michael Thomas is actually a client of ours at InvestorKit, and together we've helped him build a property portfolio when combined with his business assets is worth $20 million. That's across 13 properties, 6 residential, 7 commercial over the last 5 years. Now that property portfolio has actually also generated over $2.26 million in equity growth over the last few years alone. And there's well over $500,000 in annual rental income coming in. That's a huge passive income waiting for him as his debt levels decrease over time. And here's my favorite part. Whilst everyone else said, wait for the perfect time, it's not a good time to invest, interest rates are going up, Michael said, no, I'm gonna make the time perfect by acting now. Now, if he'd stopped every single time a scary headline came up, he'd still be waiting to start building wealth. What I want to visualize here is where he did it, just so you can actually see what a successful portfolio looks like in times of craziness, especially like that 2022 year when the markets had dipped nationally by over 9%, one of our largest, declines in the Australian property market, but it didn't mean that for Michael's portfolio. And this is why. He had a property in Sydney and we had a property in Melbourne. He had multiple properties in Brisbane. We then went over to Adelaide. We also had a property in Bundaberg that we'd purchased for him, and then we took it out west and had some properties across Perth and even regional New South Wales in Central Coast and Queanbeyan. So tell me, when you're looking at Michael's portfolio, why would you even care about interest rates rising at a national level and the country's headlines about Australian markets declining when you've almost had your asset in Brisbane double during those few years? Can you see what smart investors do that the everyday investor doesn't? He didn't care about the headlines. He focused on making a decision when he could make a decision. He focused on surrounding himself with a team of experts to be able to find the right markets across the country, irrespective of interest rates rising, because of the fundamentals for each and every city being different. It's all about getting deeper on each and every city's fundamentals and data points, not a singular outlook on one piece of data. Now, if you're enjoying this video, I just want you to know that this came from questions from other investors on our channel so they could learn more. So if you're watching this video and you've got other topics or things that you want me to talk about or jump in the comments, leave a note, drop me something that you'd like me to explore, and I'll cover it off in a future video. Let's get back to this one. Now, you might be thinking, okay, Arj, that's great. So if I'm not supposed to focus on one, what am I supposed to focus on? Think of it like you're a doctor. If you have a fever, you don't rush into surgery, do you? You run tests, you check everything, because you can't effectively treat the problem until you've correctly diagnosed the issue. Property's the same. One symptom never tells the complete story. Just like a doctor, you need to run a detailed and accurate scan on the property market before you invest. There are endless data points affecting the market, but we've actually identified 25 different fundamentals we use that put our clients at the forefront of Australian investing. And I'm going to unpack 5 of them right now. I'm no longer a doctor, I'm back to being a disappointment to my family. When it comes to the 5 fundamentals, the first one is established supply. And what you can see over here is the for sale listings across Australia. Established supply is more important than actually new build supply, because this can move really quickly in either direction, since it's all about the properties that are already built. There is currently a very low level of established supply in Australia. In fact, this number is 28% lower than this time 10 years ago, but during that same 10 years, the population of Australia has substantially increased. Even though there are more people in Australia by a huge number, there are 28% houses for sale less amongst the established houses in the country. You can't build your way out of that. If the city has a chronic undersupply of listings for sale that are established, it's a very strong fundamental and prices can rise. The second fundamental to look at out of the 25 is rental vacancy rates. And as you can see, a big fall off the cliff here, with current rental vacancy rate fundamentals in Australia marked as very strong. Now, when they're very strong, they're typically below 1.5%. And you can see here vacancy rates are currently, at the time of this video, 1.2%. We haven't seen vacancy rates this low across Australia going back to 2006 to 2008. So that huge dive following the pandemic and the vacancy rates coming down, all of this low level of vacancy rates is a strong fundamental, and it means rents will continue growing. The cities that display this number being very low, combined with the established listings being very low, means that there's a low amount of houses for sale and a low amount of houses for rent. Let's go to the third of the 5 core fundamentals to share with you, and that is actually migration patterns. But I'm not talking about overseas migration. Everyone is stuck on overseas migration, and it's the wrong fundamental to look at from property investing. You see, when it comes to overseas migration, the most common group is actually temporary visa holders coming in, and they're across student, working holidays, working visas, and so that population isn't coming in with briefcases full of cash and buying properties. So it's not that number that you need to look at as the core focus, because if that was the case, Melbourne would be booming indefinitely and never slow down, because migration in Melbourne from an overseas level is very strong. But the Grattan Institute actually released data that shares that migrants, when coming to Australia, are often renting for their first 4 to 5 years. So it shows you again the theory of migration that suddenly props up house prices isn't true and correct. What's a greater impact of house prices, again, not in isolation, but a core fundamental, is regional migration, because you're usually having people in the country move over, and they're moving over with a foundation, a job, or they're looking for an opportunity and they're ready to go. They might even have experience in Australia. They might have some assets already that they're selling down, trading and downsizing to, or upsizing but for a much lower price. There's a lot more movements happening in a more active, participating audience. And so from that perspective, you can see the migration from capital cities to regional centers wasn't just a pandemic thing. It is a lasting trend. Over the years, we've seen this number continue to remain strong, and as a result, this fundamental means that certain regional markets are benefiting from more demand than the actual supply of listings in those respective cities. Now let's go to the final 2 fundamentals. This next one is huge. Infrastructure investment. We have got over $1 trillion of cumulative spend of infrastructure in Australia, hence why this fundamental is super strong. Follow the money trail. Which cities have a higher infrastructure spend per capita is going to flow on to certain jobs. But it's important you look deeper into the infrastructure, not just the total dollar amount. Well, why? Because certain cities are supposed to have large levels of infrastructure. With the population being larger, the spend needs to be higher, which is why infrastructure spend per capita is an important metric. Because if you have a smaller regional center and that's got a $700 million hospital coming in, and that center has far lower amount of people than Sydney or Melbourne does, that infrastructure project is more beneficial, even though it's lower total dollar value spend in comparison to Sydney and Melbourne. The other thing to look at is the type of infrastructure. You've got things that create ongoing jobs, for example, hospitals, and then you've got things that create at construction jobs, for example, wind farms or renewable energy that don't require as many people to operate it and run that section following the projects. It's important not just to look at total infrastructure, but where it's being spent, spend per capita, and the type of infrastructure occurring as well. If we go over to the final fundamental, you can see it's government intervention. And government intervention is going to go crazy, and you need to watch the space. As at October, we've seen the first home buyer incentive kick in, where people are getting higher price caps, unlimited placements, no income limits, which essentially is going to create demand for first home buyers to enter with just a 5% deposit. That is an example of government intervention on the positive demand side to housing markets. So it is truly a first and first served when it comes to these benefits, because it will get more and more expensive as time goes on. If you look at the opposite, what's a weak example of government intervention? Taxes on property investors, taxes in certain states and markets that are going to make people want to invest or purchase property less. So now those are 5 fundamentals, and in summary, what do they mean? Less houses for sale, less properties for rent, more people moving to certain regional centers, lots of infrastructure being built, and then government putting policies out there that make housing more popular. Now, you can get a copy of the free report of the Australian housing fundamentals by jumping on the link in the description. Fundamental analysis will help you more than looking at the headlines that many people make the mistake of with if this, then that thinking. You cannot oversimplify property investing and property data. There is no such world where if this, insert an indicator, then that happens. It doesn't happen in property investing. And so the next time you're met with a headline or a barbecue conversation whilst you're on your journey of building wealth, stop right there and realize that there are 25 core fundamentals for the major Australian market. There are 8 capital cities with 25 major regional centres, taking it to 33 major centres across Australia where you can invest in with different market conditions in each and every location. Don't fall for the headlines that only focus on 40 to 50% of the population. Focus on all 11 million dwellings across the country and realize where data can take you to build the most successful portfolio when you're ready to invest, not when the headlines tell you to. If you found this really helpful and you're going through this and saying, well, I don't want to be that person that's focusing on the headlines and I actually want to be someone who builds a diverse portfolio, then look, it just starts with a free call and you can book that consultation using the link in the comments of this video. And in that discovery call, we'll just have a good chat to understand where you're at and what you're looking to do when it comes to building wealth and see if we can create a success story for you like we have for Michael. Jump on the links, grab a copy of the research report, book in a free call if that sounds like something that would benefit you. And thank you for tuning into this video. Don't forget to like and subscribe.